Hello friends, it's September 20th, 2023. Here's your midweek update with a focus on today's Fed meeting. First up, I'd like to give you a summary of what the Fed said today, and then let's look at the implications. First of all, the Fed paused their rate hikes. They left rates unchanged. So the current Fed funds rate of 5.25 to 5.5 is what's expected at this Fed meeting. More important than that, though, we got the dot plot at this Fed meeting. And what the dot plot is, it's every Fed official giving their personal projection for where they think rates should go. So it gives us a sense for what the Fed is thinking. And here's what we see. 12 Fed officials see one more rate hike this year. Only 7 Fed officials see no more rate hikes. And then finally, the Fed sees inflation at 2.6% in 2024 and 2.3% in 2025. What all of this tells me, this is the higher for longer scenario. So the implications of this data, we're going higher for longer. And what I mean by that is there was a thought in the market that the Fed was going to be very quick to lower interest rates and that this would be good for economic growth and for stocks and for all sorts of things. And clearly what the Fed is saying with this message is it's going to be a little bit of a longer term fight. So Fed futures, which is the market reacting to what the Fed said today, they don't show cuts until September of 2024. So we've got pretty much an entire year at these high rates and possibly even one more rate hike this year before we leave rates alone until September. The implications of these two things together is that the Fed is committed to achieving its 2% target. There was some thought about, hey, is 2.5% that much different than 2? Is 3% all that bad? Maybe the Fed might let up on the 2% target to make the economy a little bit better, a little bit more vibrant. And clearly with what we're seeing today, the Fed is saying conclusively that no, they're committed to achieving 2%. And if you look at their own math, they don't expect to get there until 2026. So we should expect to be in a restrictive rate environment all the way out to 2026. Rates will certainly come down as inflation comes down, but there's going to be restriction for quite some time in the economy. If we look here, this is what the dot plot actually looks like. And the way that you read this is the y-axis is the Fed funds rate, aka where interest rates are. These yellow dots that you see, this is each individual Fed governor, Fed official, voting for where they think interest rates are going to be. It's just a projection. This isn't binding. But if you take the average of all of these votes, you get this green line. And then if you take the average of all the votes that they cast at the previous meeting, you get this purple line. You can ignore the white line for now. And basically what this tells you is if we look at what the Fed is thinking now versus roughly 3 months ago, what do you notice? Well, you notice that the green line is above the purple line for 2023, 2024, and 2025. So what the Fed is saying with this most recent dot plot that they've released, they think that they need to go, as I said, higher for longer. So they're expecting interest rates over 5.5% by the time we get to the end of this year. Rates are still going to stay over 5% for 2024. And then as we get into 2025 and 2026, maybe by then, interest rates can finally start coming down. One more important thing when looking at the dot plot is what you don't see. You don't see 0% rates ever coming back. Even for longer term, the Fed is saying that 2.5% is probably as low as we will ever go. And so what this tells us is that period of time where we had zero interest rates from 2008 to 2020, 2021 is probably over. Naturally, the question might be, well, why is the Fed doing this? One of the reasons why the Fed came in higher for longer on their projections is that the economy has been strong, which is good, but the inflation rate has been strong as well, which is bad. If you look at the CPI, which is this blue line here, CPI has been going up for at least the last 2 months now. And if you look at what's happening with the price of a gallon of gasoline, that is going to bleed into all the aspects of CPI and the inflation rate. So the Fed clearly sees this, and they see the economy looks pretty robust right now. So they think that they have the wherewithal to keep rates higher for longer. One of the things that I'll be watching during this time, I'm going to watch what's going on with labor, with the UAW strike, with the actors strike, with the potential strike at Kaiser Permanente among the healthcare workers. I'm going to be watching that. I'm going to watch student loan repayments, what happens with the consumer. But what we're seeing right now, the inflation rate isn't going the way that the Fed wants it. So they clearly need to come in with more medicine in the terms of interest rates. And that's what they're saying. There you go. Quick update. Hope you enjoyed. We'll talk to you in a week. Thanks. Bye.